Government is talking about making major changes to tax rules for property investors. On the 12th of May, the federal budget is going to announce quite a number of changes that are on the table. Okay. Particularly, they're talking about reducing a CGT discount. They're talking about getting rid of or also reducing negative gearing benefits. And then a big change to trust distributions. Now, in this video, I'm going to break through exactly what the changes are, what it looks like currently, what it's going to look like once the changes occur. And then I'm also going to talk through a strategy that I will be using and I'll be helping my clients with. We already use it today, but this strategy is a major way to get around all these tax changes and ensure you're able to still grow your portfolio, okay, and let it be a profitable portfolio for you in the long run. Let's get into it. I'm Diane Hamad, mortgage broker and ex-banker. I've structured over $500 million in lending, and let's talk about the tax changes. So first tax change that I want to get into, the negative gearing change. Currently, if you own a property, okay, and the property costs you more than what it makes, okay, you can claim back that negative amount, okay, against your income. So for example, if you earn $100,000 and your property runs at a loss of $2,000 per year, you will only get taxed on $98,000. Okay, so it's a major tax benefit. Most people, this is in your personal name. You get this negative gearing benefit when you buy the property in your personal name and it's running at a loss. Obviously, over multiple properties and a long term, you get a major benefit of that negative gearing deduction against your income, and you end up paying less tax. Now, what they're proposing to do is reduce either reduce the negative gearing benefit, like the percentage, or reduce how many properties you can have this against. So currently, if you own 5 properties in your personal name that are all negatively geared, for example, you can claim this deduction against all 5 of those properties. Whereas they're talking about potentially reducing it to 2 properties. So you can only negative gear on 2 properties in your personal name, and that's it. Anything more that you own, okay, you can't have that negative gearing benefit. So, for example, let's say if this is your 3rd property and it's got a $2,000 loss, you will be taxed that $2,000 loss. Okay, you can't deduct it from your income, and you're still going to be taxed your full income amount, plus you have to eat the loss, the $2,000 loss on the property. That's what they're proposing. What this means from a lending perspective, when properties are negatively geared in lending and with borrowing capacity, the bank adds back that negative gearing to your income, okay, and it increases your borrowing capacity for you. So let's say they cap it at 2 properties, and it's mum and dad investors, and they own 4 investment properties, for example. What's going to happen with the banks is when mum and dad go back to the bank and say they want to borrow more money, they'll add back that negative gearing deduction for the 2 properties that you're allowed to have negative gearing for. And then the other 2, it will be a loss on paper. Therefore, it's going to deduct from their income with borrowing capacity. Okay, so it's going to reduce borrowing capacity pretty significantly, okay, if they do implement this change. Whereas now, if you have 4 properties running at a loss, all 4 are being added back, the loss is being added back to your income, okay, and it's increasing your borrowing capacity with the lender. It's not reducing your borrowing capacity with the lender, because obviously you get that negative gearing benefit with the government currently. Now, it is more than likely that they're going to grandfather this policy. So if you currently own negatively geared properties, those properties won't be affected because, like I said, they'll grandfather the policy and you'll continue getting it. Whereas if you buy new properties, okay, that's when the rule will apply. It's if you're purchasing properties under the new rules or once the new rules take place. That's when this will affect you. Okay, and like I said, this is all purchasing in your personal name. Okay, that's where you get these negative gearing benefits. Now, the next thing we need to talk about, CGT. Okay, capital gains tax. At the moment, if you own an investment property for more than 12 months, okay, and you make money, you make a profit, so that investment property has grown in value. So you bought it, for example, for $700,000, and now it's worth $1 million. So you've made a $300,000 gain on it, and you sell it. Currently, under the existing rules, okay, you only pay tax on 50% of the gain. So you made $300,000, okay, you only pay tax on $150,000. under the highest tax bracket, 45% tax bracket, in this instance, that means you pay around $67,500 in tax on those earnings, which is really good. Effectively, under the current market, you're paying tax, like you're paying 27% tax rate if you're on the highest tax bracket and you sell a property. Whereas what they're proposing with the CGT is to reduce that 50% discount. So they want to reduce it. We're talking about either from 25%, we've got articles saying 33%. There are lots of things going around. Now, I'm going to assume they reduce it to 25% so we can see what it's actually going to look like. Now, if they reduce it to 25%, you make $300,000 on your property. You only get, there will only be $75,000 of that tax-free, which is 25% of $300,000, okay? Now, assuming you're on the 45% tax bracket, you end up paying around $100,000 in tax on the sale of that property. You'll still make $200,000, okay? But obviously, it's nowhere near as good as what it is at the moment. That's the CGT change. The third change, stick with me. I know there's lots and lots of changes here. The third change, trust. Currently, if you own a trust, okay, this is one of my current favorite things about trust, is if the trust makes money, so any income within the trust can be distributed to beneficiaries, okay? And generally the way it works is the beneficiaries, the way people strategically do this, beneficiaries would be on different tax brackets, okay? You're going to have people on higher tax brackets, and then you have people on lower tax brackets. And effectively what people do is they distribute a lot of the income, okay, to the people on lower tax brackets, and then that way you end up paying less tax. So for example, you made $500,000 in the trust, okay? So let's say you were holding a property in there, it's made a gain and now you're selling it, okay? Then you can distribute that $500,000 to people on lower tax brackets, okay? Obviously, I know you also get the CGT discount at the moment in the trust, and then after that discount, you're able to distribute the money. So it's like a double benefit. Whereas what they're proposing to do is to put a flat tax rate in trusts. So regardless of what the beneficiaries are on, okay, they're saying, well, we're going to tax you at 30% flat rate anyway. So whatever, even if you have, you know, your 18-year-old daughter in there as a beneficiary who doesn't have a job, okay, 30% tax rate on everything, regardless of what's going on. Now, there is one entity, okay, that really is not going to be affected by all of this, okay? Personal names are obviously heavily affected, buying in personal names. Buying in trusts, if they do this 30% flat rate, tax rate, will be affected. If they don't do the 30% flat tax rate, then trusts will be a great way to continue going. But let's assume they're doing all these. They're going to implement everything. We're looking at the worst case scenario here. What do we do? Like I said, this is a strategy that I'm going to deploy, okay? It's a strategy that I've already been deploying, and it's a strategy that I help my clients to do, and it's going to be the best way around all this, and it's going to ensure that you can continue growing your property portfolio, you can continue making money from those properties, and if you decide to sell those properties, then you're not going to be slammed with a massive tax bill. Now, currently in your personal name, okay, obviously your tax rate is 45%, assuming you're on the highest tax bracket. Trusts, let's assume they're going to be at a 30% tax rate, okay, if they apply that flat rate. Companies' tax rate are around 25%, okay? That's the lowest tax rate in a company is 25% you can be taxed at. With trusts, okay, you pay land tax, okay? You currently pay land tax in a trust on the properties that you hold. Whereas in a company, you don't pay land tax. Depending on the states, this is also state dependent, you don't pay land tax in companies, okay? So it's already cheaper. It's cheaper in terms of tax rate, okay? And then it's cheaper in terms of no land tax. At the moment, before they implemented the rules, obviously, the absolute biggest benefit with trust versus company was the ability to distribute the income, okay? Plus asset protection. I should write that. Whereas, if they get rid of the distributions, okay, and let's say you're not too concerned about asset protection, then companies are the way to go because, like I said, it's a lower tax rate, plus you don't pay land tax, plus what I'll get into in a second is you get that unlimited borrowing capacity hack. So what that unlimited borrowing capacity hack is let's say in your personal name you have a $1 million borrowing capacity. Okay. Once you use that $1 million, you're done. Okay. Especially if they implement this negative gearing rule, then your borrowing capacity is going to be extremely limited in your personal name. So let's say it'll go from $1 million to $800,000. It's already dropped. Once you use that money, it's gone. You can't continue growing your portfolio. So the workaround for this, it's so important that you structure things correctly from the get-go, okay? And you speak to people who know what they're doing, because you need to know the workaround, especially if you want to grow your portfolio, which I'm assuming you do because you're watching this video. The workaround is to buy in a different entity, okay? Because let's say you buy property in a trust or a company. Once that property is positive, cash flow positive, okay, then the bank effectively disregards that debt because the liability is covering itself. The entity that it's held in is able to cover the liability. Therefore, the bank doesn't need to worry about it. Okay. So what happens here is that you're able to use that $1 million borrowing capacity, for example, okay, establish a new trust or company and buy again and use it again. Okay. Get that property to cash flow positive or neutral, cash flow positive, and then go again. Set up another trust or company and use your borrowing capacity again. So effectively you can use whatever you can service in your personal name from your own income. Okay. You can use that to buy properties in trusts or companies and then continue growing your portfolio that way. Now, currently it's for trusts and companies, the strategy works, but in saying that, based on everything we just discussed, beneficial to continue doing it in a company structure. This is not financial advice. You need to speak to the right professional to help you with your situation. Everything I'm giving you is effectively information. It's education, okay? Now, another thing you might consider doing, let's say you have lots of borrowing capacity. You might, and they only cap it at 2 negatively geared properties. You might buy your 2 negatively geared properties in your personal name, okay? So that you reduce the tax you pay, okay? It'll reduce your taxable income. And then your positive and your cash flow positive properties can then be purchased in your company structure. So, and then you're getting tax benefit in my personal name and I'm growing my portfolio in my company. It's a double win here. You're getting the best of everything. You're still getting your negative gearing benefit, okay? And then you're still getting benefit of not paying so much tax and being able to continue growing your portfolio and not capping your borrowing capacity by buying in a company structure. Now, the funny thing is the government is proposing these changes to help the average Aussie be able to get to the market. Based on everything I've just walked you through, the only people that this is going to hurt are your average Aussies trying to have a crack. That's the people it's going to hurt, okay? Because they're the people who can't afford or who don't know the right people to speak to, okay? They don't maybe have the risk appetite to do things in different entities or different structures. Therefore, the people they're trying to help, okay, are going to be the people most affected by all of this. The other thing is the people who aren't going to be affected are the wealthy people who know the right people to speak to at the right time and have the risk appetite to deploy different structures and strategies. It's not going to affect them. It never affects them. It always affects your average Aussie trying to give it a crack. That's who it always affects, and it's not going to help them. The next thing that I need you to consider is they're trying to obviously bring down the cost of housing, okay, by doing that negative gearing strategy, by cutting the CGT discount, okay, to make it less of a benefit for investors. But here's the part that nobody's maybe thinking about. If they reduce the negative gearing benefit, okay, on new properties, but they grandfather the old policy, which is what they do if you bought under the new policy. A lot of the time, the government will grandfather that policy. So if I have 4 properties negatively geared in my personal name, I'll still get that negative gearing benefit because I bought it under the old policy. Investors aren't going to want to sell those properties, okay? So then we're going to have an issue where there's not a lot of supply because people are going to want to hold their properties. And that's exactly what this is, a supply and demand issue. And it's only going to make supply and demand much worse because it's going to reduce the supply because people aren't going to want to sell their properties. They're going to want to hold them because they're grandfathered under the old rules, okay? And then people are going to need properties to buy which aren't going to be available to them. That's the other thing you need to consider. These exact rules happened in the UK, okay? Very, very similar rules were deployed in the UK. What happened in the UK was that rents were ramped up. Rent became extremely expensive. That's probably what's going to happen here because The investors are going to hold on to their properties. People aren't going to be able to afford to buy, okay, the way that the government is saying that they are. And then rents are then effectively going to go up, okay, because there's going to be more demand for people to rent. Same thing happened in the UK. Rents went through the roof. It really, really didn't help anything. In the UK as well, guess what? It didn't stop investors. It just pivoted the way that they do things. It pivoted the way that they bought properties in different structures and entities, okay? And at the same time, rather than people being focused on getting negatively geared properties for a tax benefit, it shifted the focus to say, hey, let's have positively geared properties that are making us money. It just shifted things for investors. It didn't stop investors. So in saying that, okay, these are the strategies, like I said, I will be using. This is one of the best ways to get around all of this, if not the best way to get around all of this. Still build your wealth, still set up your future, still set up your financial future, still set up your retirement, still do everything that you absolutely want to do in terms of property, not be extremely affected by these policies. I'm also happy to make another video breaking down company structures, okay, and getting into that in more detail to show you exactly how they work and how you can use them to start buying your properties, okay? But I hope you enjoyed this video. Please like and subscribe if you did. We upload new videos every single week, and I look forward to seeing you in the next one.